Physical silver traded at $87 per ounce in Shanghai, while Western exchanges show a price of $34. That's not a typo. That's a $53 premium, which translates to a 156% markup over the paper price. And it's not an isolated transaction. This is the actual clearing price for 100-ounce bars in physical delivery across multiple Shanghai dealers as of 6 a.m. local time today. If you think geographic arbitrage will close this gap, you're about to discover why 50,000 ounces of silver cannot physically move from London to Shanghai fast enough to matter. Look at this number, 87.30. That's the weighted average transaction price for physical silver bars reported by the Shanghai Gold Exchange as affiliated dealers in the last 24-hour trading session. The official SGE spot price shows $38.50, but that's the paper settlement price. The actual metal changing hands with bar serial numbers transferred and vault receipts issued is clearing at $87.30 in a functioning market with free capital flows and efficient logistics. This price differential would last maybe 20 minutes before arbitrageurs eliminated it. This gap has existed for 11 consecutive trading days and is widening. In a normal market, physical silver premiums over spot run $0.80 to $2.50 per ounce, depending on product form and quantity. Institutional 1,000-ounce bars typically trade at $0.50 to $1.20 over spot. Today, verified transactions in Shanghai show $8.00 premiums over the local paper price for 100-ounce bars. And when you factor in that the paper price itself is $4.50 higher than Western futures, you get to that $87 figure. To put that in perspective, the premium component alone is now larger than the entire spot price was 18 months ago. This isn't a premium. This is a complete market fracture. Let's verify the mathematics. Western COMEX futures settlement, $34.20. Shanghai paper, silver price, $38.50. That's a $4.30 basis differential, which already signals stress. Now add the physical premium in Shanghai, $8.00 over local paper. Total, $42.50. But actual transaction data shows $87.30. The difference, $44 over $80, represents the true scarcity premium that buyers are paying to secure immediate physical possession. That's a 131% premium over even the elevated Shanghai paper price. What this means in plain terms, the paper price discovery mechanism has completely detached from physical reality in the world's largest silver consuming market. China accounts for 38% of global silver fabrication demand. When the physical market in the dominant consuming region reprices 156% above the paper derivative price, you're witnessing the collapse of the pricing mechanism itself. This isn't a financial technicality. This is the moment when decades of paper price suppression meet physical shortage, and physics wins. And this isn't isolated. This connects directly to the global silver delivery system. When Shanghai physical trades at $87, while London and New York paper trades at $34, arbitrage should be automatic. Buy in New York at $34, ship to Shanghai, sell at $87, pocket $53 per ounce minus shipping and insurance. That's roughly $51 per ounce in pure arbitrage profit on a trade that should take 7 to 10 days. Every bullion bank on the planet should be executing this trade at maximum size, but they're not. Why? Because there's no physical silver available to execute the arbitrage. The London vaults are empty of unallocated silver willing to be shipped. The COMEX registered inventory won't release metal at these prices. Now look at what just surfaced from shipping manifests. Air cargo shipments of precious metals from London to Shanghai typically run 15 to 30 tons per week during normal market conditions. This week's manifests show 2.8 tons total. That's not a reduction, that's a collapse. The physical flow has dropped 91% from normal levels, and it's not because the planes aren't flying. It's because the metal isn't available to load. When you see air freight manifests dry up, while price dislocations reach 150%, you're looking at inventory depletion, not logistics problems. Here's why this matters. The global silver market has operated on a fractional reserve model for decades. The LBMA in London runs unallocated silver accounts where 100 ounces of paper claims exist for every physical ounce in the vault. This works perfectly until someone demands physical delivery. Chinese buyers are now demanding physical exclusively. They've learned from the nickel market freeze in 2022 and the LME's willingness to change rules mid-crisis. They want metal in Shanghai vaults with Chinese vault receipts. They don't trust Western paper promises. What we're seeing right now is the unallocated model breaking in real time. Chinese industrial users need silver for solar panel production, which cannot be substituted. Chinese retail investors want inflation hedges that can't be confiscated or frozen by Western regulators. Both groups are bidding for the same shrinking physical supply, and both are willing to pay whatever price is necessary. When you see inelastic demand meet constrained supply, the price becomes purely a function of available inventory. And available inventory in Shanghai is now measured in days, not months. Connect this to the COMEX situation. Registered silver inventory sits at 185 million ounces. Open interest represents 790 million ounces of claims. The ratio is 4.227 claims per physical ounce. That's manageable if only 2% of contracts demand delivery. But if Chinese buyers can't source metal in Shanghai at any price below $87, they'll start standing for delivery on COMEX contracts. If delivery demand increases from 2% to even 6%, that's 47.4 million ounces demanded against 185 million registered. That's a 25.6% drawdown in a single contract month. COMEX registered inventory has never survived a drawdown exceeding 15% in a single month without exchange intervention. The forces at work here are Chinese industrial demand, pulling metal east, and Western short sellers, pushing paper prices down through futures selling. For 2 decades, Western selling dominated. The paper tail wagged the physical dog. As of November 28th, Eastern physical demand just overpowered Western paper selling. When that happens in a commodity market with structural supply deficits and low inventory levels, you get price discovery shifting from the derivative market to the physical market. We're watching that phase transition right now. But the story gets more severe when you factor in Indian demand. India imported 187 tons of silver in October, up 340% year over year. November data isn't fully released, but customs preliminary figures show 223 tons. That's a 19.3% month-over-month acceleration. India doesn't have the industrial demand that China has. This is monetary demand. Indian households are buying silver as inflation protection and wedding season gifts. This demand is culturally embedded and completely inelastic to price. When Indian buyers see silver at 7,200 rupees per 100 grams and decide it's worth buying, they don't stop buying if it goes to 7,500 rupees. They buy more because they fear it will go to 8,000 rupees. There's another force at work here that changes everything. The Chinese government quietly updated banking regulations on November 15th, allowing commercial banks to offer physical silver accounts backed by actual metal in bank vaults. Previously, Chinese banks could only offer paper silver exposure through structured products. This regulatory change means 1.4 billion Chinese citizens can now walk into any major bank and open a physical silver account the same way they'd open a savings account. The demand implications are staggering. Chinese household savings sit at approximately $18 trillion. If even 0.5% of that savings allocation shifts to physical silver, that's $90 billion in new demand. At current prices of $34 per ounce, that's 2.65 billion ounces. Global annual mine production is 830 million ounces. 0.5% of Chinese savings could absorb more than 3 years of total global production. And we're already in a 200 million ounce structural deficit before any of this new demand hits. What I'm about to show you makes that look like a warm-up. The refinery bottleneck is now the hard constraint on price convergence. You cannot move silver from London to Shanghai without refining it. Western good delivery bars are 1,000-ounce London bars. Chinese standard is 100-ounce bars with different purity specifications and stamping requirements. Every ounce that moves from west to east must flow through a refinery. There are exactly 7 refineries globally that can process London bars into Shanghai-compliant format at scale. Their combined capacity is approximately 420 tons per month. That's 14 tons per day. Current demand in Shanghai, based on the SGE withdrawal data, is running at 23 tons per day. That's a 64% shortfall between refining capacity and demand. The arbitrage opportunity is massive, but physically impossible to execute at the scale needed to close the price gap. Even if every refinery dedicated 100% capacity to casting Western bars into Chinese format, which they can't because they have other clients and products, you'd still have a 9-ton E per day deficit. That deficit is the reason prices can dislocate 156% and stay dislocated. Now factor in what's happening in the mine supply. Primary silver mines are shutting down, not expanding. 2 major Mexican silver mines went offline in the past 90 days due to ore grade depletion. Combined production from those mines was 18 million ounces annually. That's a 2.2% reduction in global supply. New silver mines aren't being developed because the price signal from the paper market has been suppressed for a decade. Mining companies make investment decisions based on long-term price projections. When paper silver traded at $22 to $28 for years, no company approved new silver mine development. Those development cycles take 5 to 7 years. Even if paper silver goes to $50 today, you won't see new production until 2030 at the earliest. The recycling stream is already optimized. Industrial silver recovery rates from electronics and solar panels are at maximum efficiency, given current technology. You can't suddenly recover more silver just because the price doubled. The recovery infrastructure processes a fixed amount of scrap material based on what's available, not based on price. Jewelry recycling could increase, but jewelry is only 18% of demand. D, and Chinese jewelry demand is actually increasing despite higher prices, which means less jewelry is being recycled, not more. There's the trap. Supply is inelastic. Demand is inelastic. Inventory is depleting. And the refinery capacity that could theoretically balance east-west flows is already at maximum utilization. The only variable that can adjust is price, and that adjustment is happening in Shanghai because that's where physical scarcity is most acute. Shift perspective to the Western bullion bank position. These banks are short silver through COMEX futures. They're short because they hedged client OTC derivatives products. Those short positions were established when silver traded at $22 to $26. Current mark-to-market losses at 34 are already significant. But now they face a scenarios where their clients, who are long silver through OTC products, start demanding physical settlement instead of cash settlement. Those clients are reading the same Shanghai price data you are. They're seeing $87 physical silver and wondering why they should accept $34 cash settlement. When OTC derivatives clients demand physical delivery, banks have three options. First, source physical metal from the COMEX by standing for delivery on their short hedges, which defeats the entire purpose of the hedge. Second, buy physical metal in the open market at spot plus massive premiums, which crystallizes enormous losses. Third, invoke force majeure clauses and refuse delivery, which destroys client relationships and potentially triggers legal action. All three options are catastrophically bad. The banks are in a prisoner's dilemma where the optimal individual strategy create a collective disaster. Every attempt by these banks to acquire physical silver to satisfy potential delivery demands drives the spot price higher. That increases mark-to-market losses on their short positions. That triggers additional margin requirements. That burns capital. That tightens risk limits. That forces position reduction. That requires buying back shorts. That drives prices higher still. It's a reflexive loop where every defensive action amplifies the problem. And here's the feedback mechanism with no exit. As Shanghai prices reach $87, more Western investors become aware of the dislocation. That awareness drives physical buying in Western markets. That increases premiums at Western dealers. That depletes retail inventory. That forces dealers to source from wholesalers. That pulls inventory from COMEX and LBMA. That tightens registered inventories. That widens the basis. That makes hedging more expensive for banks. That increases losses. That accelerates the need to cover positions. The cycle reinforces itself at every step. Remember when I showed you the Shanghai price of $87.30? Now overlay the fact that the Shanghai Gold Exchange silver inventory dropped 47 tons in the past week. That's a 3.8% drawdown in available physical stock in 7 days. The exchange started the year with 1,120 tons in total inventory. Current level is 1,094 tons. That's a 40% drawdown year to date. If drawdowns continue at the current weekly rate of 47 tons, the SGE will hit operationally critical levels below 800 tons in 6.3 weeks. Once inventory falls below that threshold, the exchange has historically restricted withdrawals or implemented delivery delays to preserve clearing capability. The international dimension creates impossible physics. Silver mining occurs 31% in Mexico, 17% in China, 12% in Peru. Chinese production stays in China. Mexican and Peruvian production historically flowed to Western markets and then to China based on demand. But now Mexican refiners are exporting directly to China because the premium differential makes that the only economical route. A Mexican refiner can sell to China at 42 delivered or to the US at 36 delivered. The choice is obvious. This means Western markets are losing access to Mexican production just as Western registered inventories hit critically low levels. The South American supply chain is redirecting. Peruvian silver concentrates were used to ship to European smelters. Now they're shipping to Chinese smelters because Chinese buyers are prepaying for concentrates at premiums. When you prepay for my output at premium prices, you lock in that supply before it can reach Western markets. Chinese industrial buyers learned this strategy from the cobalt market. Lock up upstream supply through offtake agreements, secure the physical metal, and let the Western paper market trade at whatever price it wants. Based on the current trajectory, here's how this plays out. Most likely path, roughly 60% probability. Shanghai physical premiums remain elevated at 6 to 10 per ounce over local paper prices for the next 90 to 180 days. Western paper prices gradually rise to $42 to $48 as COMEX inventory depletion forces the paper market to acknowledge physical scarcity. The total Shanghai physical price gradually converges toward $52 to $58 as refinery capacity slowly increases and some new supply reaches the Chinese market. This occurs without exchange intervention, but with continued delivery delays and extended settlement times. Timeline is Q1 to Q2 2026. Key indicator: when COMEX registered inventory falls below 150 million ounces, this scenario is confirmed. That level represents the point where the exchange cannot facilitate delivery on more than 3% of open interest without depleting inventory to operationally critical levels. Alternative path: 30% probability. Shanghai physical prices spiked to $95 to $110 as Chinese industrial users panic about production shutdowns due to silver unavailability. This triggers emergency government intervention, where the Chinese State Reserve Bureau releases strategic silver stocks to stabilize the domestic market. Simultaneously, the COMEX implements position limits and maximum delivery restrictions to prevent inventory depletion. Western prices rise to $48 to $62, but remain structurally below Shanghai prices as capital controls prevent full arbitrage execution. This only happens if solar panel production actually faces material shortages in the next 60 days, or if a major Chinese silver fabricator announces production curtailment. If you see Chinese solar stocks declining more than 15% in 2 weeks, this path is activating. Tail risk scenario: 10% probability. The London bullion market. Association experiences an unallocated account default, where a major bank cannot deliver physical silver to clients demanding allocation conversion. This triggers a trust collapse in unallocated precious metals accounts globally. Silver prices gap to $125 to $180 as every unallocated account holder simultaneously demands conversion to allocated. The LBMA suspends physical delivery for 30 to 90 days to restructure the market. This requires an unusual convergence of factors: a major bullion bank facing capital stress from unrelated issues, an unexpected surge in allocation, requests from multiple large clients simultaneously, and the inability to source physical metal from any global supplier at any price. Impact would be systemic across all precious metals markets. This is unlikely, but not impossible. If you see LBMA silver forwards trading at annualized rates exceeding 15%, which would indicate extreme tightness in the lending market, watch for this scenario. Track these metrics in this order of importance. Primary indicator: Shanghai physical premium over Shanghai paper price. Current level: 8.0 rulers per ounce. If this moves above $10, it signals the physical shortage in China is accelerating beyond current projections. If it exceeds $12, it indicates potential industrial production impacts are imminent. Check this daily through Shanghai dealers' published spot prices versus actual transaction reports. These are available on Chinese precious metals forums and dealer websites with real-time updates. Secondary indicator: Shanghai Gold Exchange total silver inventory. Current level: 1,094 tons. Watch for a decline below 1,000 tons, which signals the exchange is approaching operational limits. If inventory falls below 850 tons, expect SGE to implement withdrawal restrictions or delivery delays. This data is published weekly on Friday afternoons, SGE time. Tertiary indicator: COMEX silver. Registered inventory as a percentage of open interest. Current level: 23.4%. 185 million ounces registered versus 790 million ounces in open interest. If this ratio falls below 20%, it signals the COMEX is approaching the threshold where delivery demand could exceed available inventory. If it falls below 15%, expect COMEX to modify delivery rules or implement emergency position limits. This data updates daily via COMEX warehouse stock reports. Confirmation metric: Shanghai to London air cargo precious metals shipments. Current level: 2.8 tons weekly. If this increases above 8 tons weekly, it indicates some physical flow is resuming, and price differentials may begin to compress. If it remains below 4 tons weekly for 4 consecutive weeks, it confirms the arbitrage is physically impossible to execute ADA meaningful scale. This data is available through air cargo manifests, published by major freight forwarders with a 1-week lag. From a positioning perspective, understanding this means the Western paper price is no longer the relevant price for physical silver. The Shanghai physical price is now the marginal clearing price for the global physical market. The 6 to 12-month window is when this repricing fully transmits to Western markets. Historical patterns suggest that when physical markets in the dominant consuming region dislocate from derivative markets, the derivative markets eventually reprice to match physical within 9 to 18 months. That's what happened in copper in 2006, in palladium in 2000, and in rhodium in 2008. Silver has larger inventory buffers than those metals had, which could extend the adjustment period, but the fundamental dynamics are identical. The options market is pricing in expectations that don't match this physical reality. COMEX silver options for March expiry show implied volatility of 52% for at-the-money options. That's elevated but not extreme. But the skew shows something critical. 25 delta call options trade at 61% implied VOL, while 25 delta puts trade at 48% implied VOS. That's a 13-point skew premium for upside calls. This tells you options traders are positioning for upside explosions, not downside risk. When professional volatility traders are paying premiums for upside protection, they're seeing the same physical market stress you are. They just can't openly discuss it because their compliance departments restrict public commentary on positions. The derivative market structure creates additional pressure. There are approximately $31 billion in outstanding silver derivatives across global banks, according to the Bank for International Settlements. These aren't simple futures. These are barrier options, Asian options, variant swaps, and other exotic structures that become exponentially more expensive to hedge as spot prices rise and volatility increases. A bank that sold a $30 barrier knock-in call option when silver was at 22 is now massively in the money on that option and must hedge it by buying more silver. That hedging demand is additional buying pressure on top of the industrial demand and investment demand, already overwhelming the supply. The central bank dimension adds complexity. Central banks hold 23,000 tons of gold, but essentially zero silver. Gold is a monetary metal. Silver is not officially. But if silver reaches $87 in physical markets while gold trades at $2,650, the gold-silver ratio drops to 30:1. Now consider what happens to industrial user behavior. A solar panel manufacturer uses 12 grams of silver per panel. At $34 per ounce, that's $13.8 in silver cost per panel. At $87 per ounce, that's $35.20 in silver cost per panel. The manufacturer's total panel cost is $188. So silver goes from 7.7% of the cost to 19.6% of the cost. That's material, but not production stopping. The manufacturer will pass the cost to buyers. But what the manufacturer cannot tolerate is a production stoppage due to the unavailability of silver. So they start hoarding silver inventory. Instead of 30 days of inventory, they target 90 days. That triples their working capital tied up in silver. That's 60 additional days of silver demand hitting the market immediately. When industrial users shift from just-in-time to just-in-case inventory strategies, they remove metal from the market permanently. The electronics sector faces identical dynamics. Silver is in every smartphone, every laptop, every EV electrical system. It's non-substitutable in high-reliability electrical contacts. Electronics manufacturers are now building silver inventories beyond their normal operating levels. The global electronics industry consumes approximately 240 million ounces of silver annually. If industry inventory levels increase from 30 days to 75 days, that's an additional 30 million ounces of demand hitting the market over the next 90 days. That's 3.6% of annual global production absorbed into inventory buffers. Everything we've covered points to one conclusion. Let me lay out the sequence. First, Chinese demand for physical silver has overwhelmed local supply, creating $8 premiums over paper prices. Second, refinery bottlenecks prevent arbitrage from closing the east-west price gap. Third, COMEX and LBMA inventories are depleting as Western buyers recognize the dislocation. Fourth, my supply is inelastic and recycling is maxed out. Fifth, industrial users are shifting to panic inventory building. Sixth, Western banks are trapped short with no good options. Seventh, the paper price discovery mechanism has lost control of the physical market. This exact pattern occurred in 2008 with rhodium. The setup was similar. Industrial demand exceeded supply, inventories depleted, paper prices lagged physical, then paper repriced violently. Rhodium went from $1,200 to $10,000 in 18 months. But there's a critical difference now. Silver has a much larger market, much more industrial embeddedness, and much more retail investment interest than rhodium ever had. That changes the repricing trajectory from a spike and crash to a sustained structural repricing. If silver follows rhodium's 733% price increase trajectory, you're looking at $250 silver. That's not a prediction. That's what happens when paper markets lose control of physical price discovery in commodities with supply deficits and industrial criticality. Run the numbers forward. If Shanghai inventory continues depleting at 47 tons weekly, and COMEX registered inventory declines at the current 2.3 million ounces weekly, we hit critical thresholds simultaneously in mid-February 2026. There's no scenario where both exchanges continue normal operations past that point without either massive price increases that incentivize sellers or emergency exchange interventions that restrict deliveries. The math is absolute. The decision makers at exchanges face an impossible choice. Option 1, allow free market price discovery, which means letting physical premiums rise until they incentivize enough supply to clear the market, potentially meaning $60 to $90 paper prices to match physical. That option preserves market integrity but destroys short sellers and creates financial instability. Option 2, implement delivery restrictions and force cash settlement, which preserves short sellers but destroys market credibility and drives all physical buyers to over-the-counter markets outside exchange control. Both paths lead to the same result: paper silver markets losing relevance as price-setting mechanisms. They've boxed themselves in. And here's the trap. Every attempt by exchanges to manage orderly price discovery through delivery restrictions pushes more buyers into the physical-only market. That accelerates inventory depletion outside the exchange system. That makes the imbalance worse, not better. Because when you restrict delivery on an exchange, you're telling market participants the exchange can't be trusted to deliver. That drives them to secure physical outside the exchange. The mechanism designed to preserve stability creates instability. Every unit of delivery restriction produces multiple units of off-exchange physical buying. It's a self-reinforcing spiral with no exit. Bottom line, Shanghai physical silver at $87 isn't an anomaly. It's the true clearing price in the world's largest consuming market, where paper promises have been replaced by physical-only transactions. The key points. Physical scarcity in China is driving prices 156% above Western paper markets. Refinery capacity cannot close the arbitrage gap. COMEX and LBMA inventory depletion is accelerating. Industrial users are panic building inventory buffers. Western banks are trapped short with mounting losses. The critical window is the next 60 to 120 days. The outcome depends on whether exchanges implement delivery restrictions or allow free market repricing. What I'm tracking now, whether Shanghai physical premiums exceed $10 per ounce, which would signal the shortage is intensifying beyond current projections. Also, monitoring for any COMEX announcements about position limits or delivery modifications, watching closely. If this analysis added clarity, like this video. For more breakdowns like this, subscribe. Share this with anyone who needs to understand what's actually happening. See you at the next one.